Get ready to enter a brave new world with your host, Vasant Dhar.
Brave New World is sponsored by the Fubon Center for Technology, Business, and Innovation at the NYU Stern School of Business. For more color on the podcast and additional commentary, please subscribe to my newsletter at vasantdhar.substack.com. Hello, and welcome to Brave New World. My guest today is David Gardner, co-founder with his brother Tom of the Motley Fool, which is an investment advice company best known for stock picking newsletters, market commentary, podcasts, and paid services. It's been around for over 30 years. David has a recent book called Rule Breaker Investing: How to Pick the Best Stocks of the Future and Build Lasting Wealth, which is the subject of our conversation today. David, welcome to Brave New World. Delighted to have you on the show.
I love being here, Vasant, and I especially appreciate where your name comes from, because we must be both Shakespeare fans. We pulled our name, the Motley Fool, from As You Like It, which is my favorite of Shakespeare's comedies. But, of course, Miranda in The Tempest and the line used ironically by Aldous Huxley. I don't know, Vasant, whether you intended ironically or genuinely in that naive way that Miranda intended. But anyway, I love the Shakespeare in this.
How about that? Because, I studied As You Like It in high school. It was one of the Shakespearean books assigned to us, Julius Caesar, As You Like It. Yeah, wow, how about that? I even remember the characters, Rosalind and Celia.
You have a remarkably good memory if you can do that.
So David, like several of my other guests, you need no introduction, as the creator or co-founder of the Motley Fool newsletter. By the way, I love the name. And, when I did the podcast with the Motley Fool, I was amused by the emails, so-and-so at fool.com. So you must be chief at fool.com.
Well, my official title is Chief Rule Breaker at the Motley Fool. So yeah, and at fool.com. And by the way, Vasant, when we applied for that URL back in the mid-1990s, there was no competition. Nobody, I don't think, wanted fool.com. So that was an easy $9 purchase.
As was mine. I bought dar.com. I just wish I had bought many more of those URLs. I just wasn't thinking big enough. But David, why don't you start by just telling us a little bit more about yourself, where you grew up, what influenced you and ultimately led you to be a fool?
Sure. So I was born in Washington, D.C. to two parents, one of whom was a Harvard-educated lawyer who was here in Washington, D.C. working in banking law. Although my father, Paul Gardner Jr.'s true passion was and is, happy to say he's still with us, the markets. Specifically for Dad, macroeconomics more than anything. But and then my mother, from an Irish family, although a few generations hence, a homemaker, an artist, a society woman. And I would say in my own youth, she was the rule breaker in our family. So in a lot of ways, I think of my mother going against received mores was a model for us. She wasn't rebelling all the time, but she was a very independent thinker. And both my parents were just fantastic parents. And I was the oldest of three kids. My younger brother, Tom, is our CEO today at the Motley Fool. And I was raised in really privileged circumstances. I went to great schools. I ended up going away to prep school in New England, boarding school. And from there, I obtained a full scholarship, a neat trick, if you can pull it, to the University of North Carolina, Chapel Hill, called a Moorhead-Kane Scholarship. And there in my sophomore year in a creative writing class, I met the woman I'm married to today, Margaret, who is also a Moorhead-Kane scholar. And so we both had a love of literature. We're humanities people. But somewhere, I've skipped a lot because I don't want to give an overlong answer to a wide open question. But I want to say two things, I guess. First of all, I've always loved sports. So as the age of sports analytics began to dawn it started in the 1980s. I think Bill James and his baseball abstract for baseball fans, or those who've seen or read Moneyball, will recognize Bill James. But I was a huge fan of that approach, which was taking a ground zero view, a tabula rasa look at sports, and saying, hey, why is everybody saying the batting champion is whoever has the highest batting average? That's not actually a great measure, for example. And so I was highly influenced by my love of sports combined with an interest in asking better questions and coming up with numbers that were more consequential that ultimately, even though I had nothing to do with it, because I was just a young graduate, but I was writing some freelance articles back then in that area. And of course, the whole world of sports analytics we've seen grow up right alongside AI, Vasant, over the last 30 years. So of the two things I wanted to add about myself, one is just that love of sports, that love of metrics, numbers. I'm an English major, but I try to develop both sides of my brain, and that's my numbers side. The other thing I wanted to convey was a love of the stock market. We were raised, as I mentioned, by a dad who really loved investing. His father had bought individual stocks before him. And when we turned 18 for each of his kids, my dad said, here you are. I've invested for you from birth. This is all you're ever getting from me. Don't screw up. And he was teaching us about the stock market and the idea of buying directly into companies. This sounds like a radical notion today, since we've somehow evolved to a world where it seems very risky, we're told, to buy individual stocks. For me, I would never have thought to buy a fund. Why would I give over and pay a manager to pick stocks for me when I could do it myself? And so there was very much a grounded sort of pull yourself up by your bootstraps, figure out the world mentality that was implicit in how we were raised, and then especially how the stock market began to become an increasingly important thing for me as I entered the adult world.
So, I really enjoyed reading a book, which is called Rule Breaker. I just actually came back from Europe. I was on a trip to Austria and then Prague. And on my way back yesterday, I finished reading your book. And so when you say, I'm guessing that, because you refer to batting average, I'm guessing that I guess what people overlook is home runs, because you refer to Babe Ruth, who struck out most often, but then he also had the biggest home runs. And that's a theme that sort of runs through your book, isn't it? Aim for the big winners, what Peter Lynch would call the 10 baggers, or, which means something goes up tenfold. So say more about that. Like, let's get into your sort of philosophy. And, because there were lots of things in your book that really resonated with me. And there were others that was like, that gives me pause. And so we'll touch on those as well.
Let's talk about both. And thank you for this opportunity to have this conversation. You had already starred on Motley Fool broadcasting. We have a TV channel on our website called Fool 24, Vasant. And a few months ago, you made a real impression with what you conveyed to us. So that's how I got to all of a sudden be connected to you and have this conversation. Let me just speak a little bit about then, batting average. Batting average, you're right, does not measure home runs. It does not measure the quality of the hit. We won't go deep baseball here for people who don't care about baseball, but we were essentially calculating a very simple percentage. What is the percent of the time when you step up to plate and be in the batter's box that you are going to get a hit? And so your batting average would, a good one would be 300. 30% of the time, taken out to an extra decimal, 300, 30% of the time you are getting a hit. And that is largely how the numerics started and lasted for decades in the United States of America as we evaluated hitters. And then comes somebody outside the industry altogether who never really played the game, just a journalist observing, a beginner's mind. He said, well, why are we looking at batting average? We're not counting home runs are much more valuable than singles, but all batting average notices is that you got a hit. And by the way, in between home runs and singles, there are doubles and triples. And we should be recognizing the value of that. Not only that, but a little bit of even more hidden in plain sight, the value of walking. So if you get 4 balls, as baseball fans know, you get a free base. And that is not even included in batting average, because when you go up and draw a walk, that is not counted as an at-bat. You were not technically in the batter's box. You didn't have a chance to get a hit, so it's ignored altogether. But of course, some of the great baseball players of all time, today and 100 years ago, could draw 100 walks in a year. And if you only get up 600 times in a full season, and 1/6 of the time you're getting on base, and we're not counting that, we're highly misunderstanding value creation on the baseball field.
Yeah, that's like a free hit, really.
It is.
But because people are afraid that you might actually do better than that.
That's right. And so you have much of the interest and everyday contributions. It's not like the rules of the game changed. It's just what we were looking at as observers, what we were scoring and valuing, the algorithms that we set in our own minds as to how we're going to evaluate performance was benighted. It was very simplistic. And then along comes Bill James and he starts poking at the establishment. And some people were very open to that. But for the most part, he was shunned. It took him 10 years really to start getting an audience. Eventually, one of the general managers in Major League Baseball, Billy Beane, as the story goes, really embraces James's challenge. And then all of a sudden, a small market team, which is no longer even in Oakland as we talk here in 2026, but that small team starts to outperform everyone's expectations. They have a small budget and they're going to the playoffs each year. And so all of a sudden, I would say the momentum behind analytics and better thinking took off. And now these days, of course, it's ubiquitous and the Athletics are no longer distinguished in this way. And they've kind of become also-rans.
So David, usually I end my podcast by asking my guest for advice to young people. But in this case, I'm going to start with that because, I feel that there are some lessons in your book that are particularly important to young people. One of them being, live within your means, right? That, live slightly under what you need. So you've got some money left over for investing as opposed to living beyond your means, right? Great advice. And, my friend John Sexton, former president of NYU, had similar advice, that if you really want to do what you want in life, find a way to live within your means. I usually tell young people, that I don't think you should be trading in the stock market because you're just going to lose it. And the more frequently you trade, the more you lose. And so, that's one of my pieces of advice to young people is don't engage in high frequency trading, which is sort of consistent with what, you're talking about, which is invest for the long term. So I want to start with this because money is one of the most important things in our lives. Money, health, family, right? Those are the three most important things. So let's start with that. Like, what advice do you have to young people?
Well, you've already given one of my favorites, which is live below your means. And I just want to say that having started the Motley Fool now in our fourth decade, and therefore being very much in touch with conversations with people about money, investing, their families, the things that you just talked about that matter so much to us, Vasant, I have seen families that you and I would consider poor that actually manage to live below their means and save. And then, of course, we can all think of star athletes, celebrities who make far more than you and I ever will and can't do that and end up declaring bankruptcy or mess up their lives. So it's very evident to me that whatever hand we're dealt, and games are a constant analogy and metaphor that I draw because games I love most of all. I'm surrounded in this room talking to you by 683 board games that sit on all my shelves because that's how much I love games. I just love to be surrounded by games. But knowing full well that the game of investing is one that everyone can play, but in order to play it well and to do so over the long term, the only term that counts, Vasant, we need to have savings. So I think it's actually quite easy to invest relative to just save and get to that first dollar of savings. So, that's a quick thought. But I mean, I wrote Rule Breaker Investing really as much for younger people as people our age, because of course, the younger we start compounding returns, the more powerful money will become and our freedom and agency on this planet will become as a consequence of saving and then investing. So the earlier that we can reach people, this is something that we do at the Fool Foundation, which I'm the chair of at the Motley Fool, our Fool Community Foundation. We're trying to get right there into schools and get people realizing the benefits of compounding returns.
Great. So let's get more into compounding, something that Warren Buffett draws attention to as well. That is the importance of starting early. So as a quote-unquote pracademic who teaches and invests professionally, the one piece of advice I give aspiring investors is to avoid trading too frequently, especially if you don't have a system or a process. Otherwise, the more you trade, the faster you lose your money. It's like going to a casino. That's reverse compounding. For those who have no time or interest in markets, I suggest that they buy an index of a country that they believe in, such as the S&P 500. But if they have the passion and the time, develop a system and a process for investing, which is also something you talk about in your book. Now, in my kind of AI-based algorithmic trading, I look for an edge and try to compound it, by taking as many swings at the plate as possible every day to multiply the edge. Now, your kind of compounding happens from holding winners for very long periods of time. Resist selling early is one of your mantras. But how do you make these decisions wisely, considering that the literature and evidence on humans as investors suggests that very few professionals beat the index such as the S&P 500 after fees on a long-term basis? So stock picking ability is exceptionally rare. How do you get to your quote-unquote rule breaker portfolio? Does picking those huge winners and figuring out how much of your money to allocate to them require a certain kind of process or discipline? How do you get there?
Well, first of all, I love that you care about this enough to have made it a big part of your career. I've enjoyed reading your book, Thinking with Machines. And so I'm familiar with some of your background, and I think it's phenomenal, Vasant. In fact, I just want to underline that you even came to our country or worked with somebody like Herbert Simon. And I'm highly enamored of all of these things. So congratulations for the life that you're leading. And it's phenomenal, and I'm honored to be on the podcast. I generally agree with index investing. The Motley Fool, when we first wrote our first book, a bestseller, The Motley Fool Investment Guide, published in 1996, chapter 2 or 3 said, hey, invest in index funds. If that's all you want to do, that's a perfectly valid approach. And you'll remember this because both of us have some gray hair. That was a radical statement at the time, in large part because the mutual fund industry was dominated by managed mutual funds charging 1% or more, usually assets under management per year, and sometimes came with load sales fees on top of that. And so it was a very strong, very subversive thing to do, or even for us to say. And so we ended up often being challenged on CNBC or in other contexts because so much advertising money was behind Fidelity in the managed fund industry. It's still a very large industry today, and I think that indexing is just clearly superior, and that's why Vanguard, over the last 30 years, has become such a gigantic asset manager. So, of course, this advice generally accords with the direction of my own thinking. And I would say I grew up, I won't say the same of you, you can agree or not, but I think there were two dominant schools of thought around investing, and we just covered one of them. Jack Bogle, Vanguard, Index, just Index, S&P 500, Total Market Index Fund. You can't pick stocks. It will just be luck if you beat the market averages. And that is the dominant school today. There's a second very influential school that everyone knows, and I would call that the Warren Buffett school. And this flies in the face of the first school because this is all, I don't never hear Buffett talk about indexing. He probably admires it, but he has trained many people to think about buying stocks directly, individually, as he did through his insurance company, and making himself famous and extremely rich by never buying the index fund, by specifically purposing this company, not that one. And I would also say about that he has become so influential, so copied, quoted, and admired that approach, which again goes against school one, therefore it stands on its own legs, but it's almost like the only way that most people see that you would ever want to pick stocks if you were daring enough to ignore school number one. And I'd like to point out just about my own perspective that I think that there's a third way. And I think that I have been, without intending it, as I started in my 20s doing what I was doing, I think that I was blazing the path for self-directed individual investors who admire Buffett, but pick completely different kinds of companies. And I'm very happy to say it's worked wildly well. We have gone against what most academics conclude, which is that it would just be luck to beat the stock market. We have beaten the stock market consistently. We've beaten it extremely. And I've shared it out as I've gone. All the way through. My record is public, etc. And I even pick stocks on my podcast. I pick groups of 5 stocks. I track everything over the course of time. And so I've ended up with a group of companies that Warren Buffett has never really invested in. Amazon, Tesla, Netflix, NVIDIA, For a while, Buffett said, as if you saw my book, there's a great headline, how he would never buy Apple. And then he ends up owning more Apple than anybody, although he ended up selling. And while he's always owned more than Motley Fool members ever will combined, we got in earlier and we're holding longer. And so a lot of the approach that I've advocated, which I call rule breaker investing, because we're breaking the rules of how people think about playing this game. This is, I think, enabled those who followed me to see through school number one and school number two. It's not to say we don't admire it. It's not to say most people shouldn't be in school number one. But there is a third way.
Was Charlie Munger's way sort of the little bit towards where you're going? I remember Warren Buffett saying, that he believed in buying value stocks, paying sort of, the quote was like bargain prices for good stocks, but he missed the exceptional stocks. And I think he said somewhere that Charlie Munger made him see the value of paying up for amazing stocks. There were times you just had to pay up. You couldn't get them cheap, right? Because they were hardly ever on sale. And that seems to be one of the themes in your book too, right? Which is that really good stocks are rarely on sale, right? And so the whole sort of buying on dip philosophy doesn't really get you too far when it comes to like trying to identify really good companies.
Well, I think that's well summarized, Vasant. I would say that, yes, I do stand for that. I practiced that now, and 35 years later. So that is indeed what I've been doing. I do think that of the two, Munger is a little bit more the rule breaker. But let's be clear, these are two geniuses who have created untold amounts of value in the world. And I'm deeply grateful for Munger, Buffett, and Jack Bogle, who became a friend of ours at the Motley Fool, somebody that we highlighted in conversations like this over the years. So these are all exemplars for me. And I would also say that even Munger didn't seem to have a high Magnificent Seven score. And I will briefly define my term. So as you know, there are groups of stocks that we start to say, hey, look at how those stocks are doing. The Nifty 50 back in the 70s, late 60s. And then there were FANG stocks 10 years ago. And the catchy phrase now, as you know, is Magnificent Seven. And most people who are into this can name at least most of them. But I will just say that I like to reframe things. And I know that this is something that you've written about and talked about. When we reframe a question or how we frame things matters so much for what outcomes we get. So my reframing of the Magnificent Seven is to ask the provocative question, what's your Magnificent Seven score? And your score is, if you take the years that you've actively held to today, each of those seven stocks, and summed them, what is your Magnificent Seven score? And I just want to say, I'll say mine in a sec. And if it sounds like I'm bragging too much, I'm sorry, but it's the truth. My Magnificent Seven score is 109. I've never had Microsoft to my detriment, but it does mean that I have active holds on the other six companies between 10 and 20 years each, and it equals 109. I don't think that
So what does the 100? So what does the 109 mean?
The 109 means that I've held Netflix since 2004, so that's a plus 22. I've held NVIDIA since 2005, so that's a plus 21. And we just keep going down the line, and we add up the holding periods through. You can't have sold, though. This is actively held today. And so a way that I try to express in conversations like this how I think different, or how I've acted, not just thought, differently from, I would say, the rules that have been laid out for us, the way that we break the rules, inheriting Goliath's world. How do we be David? And no self-reference intended. It just so happens my name is the same as the biblical figure, but we're all born into Goliath's world. This happens with disruptive innovation, as you know. This is another topic of interest for you. Companies that come along and change. Netflix changing the world that we had all inherited from Blockbuster, one example. So this is my way of trying to explain to people that there is a different way to approach the markets that I think can win wildly, and that I have invested my whole career in showing to people through the actions that I take. And the Motley Fool business, of course, is partly premised on people subscribing and following along with what I or anybody else at the Motley Fool is doing. So that is the what's your Magnificent Seven score question.
So, I'm glad you brought up the Mag 7, because I don't have quite the impressive Mag 7 score that you do. But here's the thing, right? If you hold the Mag 7 forever, chances are they're going to go to zero, right? I mean, I remember like reading this book, and I wish I could remember the author who said, there are no great companies, only great indices. Because if you look at the turnover in the S&P 500, like over the last 50 years, it's huge, right? So these Mag 7 sort of are Mag 7s of today, but they'll be the Mag 7s of tomorrow will be different. And one of the things I sort of thought about when I read your book, which says don't sell. I'm like, no, but you got to sell. At some point you have to sell. And that's the most difficult decision, right? So I'll tell you, 60% of my portfolio is NVIDIA and Google, right? And the reason it's that is because in 2017, I told my systematic investing class, I said, you know what? I'm not a big believer in stock picking, right? Which is why I teach a class on systematic investing. However, every once in a while, opportunities present themselves. And I had just listened to Jensen Huang at NYU at the Future of AI conference, and I could see the way sort of deep learning and AI was going. And I'd said to myself, wow, these guys are like in the middle of this space. And so I traded it for a bit until my chief scientist said to me, Vasant, you should know better than to like be trading this stuff. If you really believe in it, hold it, right? So I did. And so I told my class, I said, you know what? Every once in a while, there are opportunities. And if I were you, I'd buy NVIDIA because they're in the middle of this AI thing, which is, I think I would make a bet that the upside is much bigger than the downside. I said, I'd buy Google because Google doesn't give a damn about its customers. Have you ever tried calling Google customer service? Right? I said, wow, what an amazing business where they don't care about what their customers, you can't even reach them. They just want to push out good products and that's it. And I said Netflix because to me, that just seems like the future of entertainment. But beyond that, I said, I don't know any better. But every once in a while, these sort of strategic opportunities present themselves. Google, because it was an emerging powerhouse with billions of users and no customer service, no need for it. I mean, what an amazing business when there's no need for customer service. And all that data they collect is their ever-expanding moat. And Netflix, because it was creating the future of entertainment. So what are the strategic opportunities these days? Space, robotics, optics?
Well, first of all, congratulations. And I love that your lesson, you've modeled for your students that you would buy an individual stock. And that's something that I would love to see every student do. It isn't to say you can't be part of school number one and with Bogle index most of what you have, but I would love it if it was taught in schools these days that you can buy one stock. Everybody should have one stock. Maybe it's 1% of your overall net worth. We would be a stronger country. We would have more intellectual curiosity and more people plugged in and caring. We would have more owners if more people owned direct, whether it's Chipotle or Intuitive Surgical or Axon Enterprise. Any of these companies is a fascinating kind of a company that will attract some youthful eyes and we can be invested in. And to think, Vasant, that you held those two fantastic companies, some of my favorite companies, to become that big a part of your financial future is remarkable. And
but here's the question that I didn't ask, which I keep asking myself, right? I'm now holding these two multi-trillion-dollar companies, right? And, they've been, maybe 5-10 baggers for me, but they're not going to double again, right? That is unlikely to happen. So should I be selling? And that was one of the questions that I had because your book seems to imply never sell. Like some of your stocks will go to zero, or actually one of the guidelines you say, to be fair, is sell if you find a better opportunity. But that's a hard thing to define. So would you be selling NVIDIA now?
I would not be selling NVIDIA now, unless it was too large a part of your portfolio. Because if you've read through to the end of my book, you know that thinking about the principles that guide our own portfolio management and construction, this is something many people haven't been coached on or talked much about. And I have 6 principles at the end of the book about how to manage your portfolio. And principle number 4 of the Rule Breaker portfolio is establish your sleep number. And what I mean by that is, what is the percentage, your sleep number, dear listener, is the percentage you would allow your largest holding to become as an overall percentage of your net worth and still sleep at night. So some people have a sleep number of 1. They're invested very broadly, diversified in index funds. No single company would represent more than 1% of their portfolio. And if it did, they would sell it down or start to lose sleep. They have a very low sleep number, very common these days. I've been in an investment club where there was a rule in the club. Anytime a stock becomes 10% or more of the club portfolio, we sell it down back to 10%. I didn't particularly like that rule, but that was the club's rule. And so the club's sleep number was 10. Entrepreneurs, people who have their own business, usually the majority of their net worth is invested in that business. They have a much higher sleep number by default. And so this is when I say I would not sell NVIDIA today, asterisk. The asterisk is if it's over your personal sleep number, I'd be the first to say redeploy. And if it is, by the way, there are lots of other great companies that we can own besides NVIDIA and Alphabet, both of which I own and both of which I have recommended for a long period of time and deeply admire. But I want us, there's that second question you asked, Vasant, which is, do you never sell? Doesn't everything just go to zero over time? I don't think everything does go to zero over time. I'm certainly agreeing that everything is ephemeral and the world keeps changing. But an example of as to why you would want to hold a company for a long period of time, maybe as long as your whole lifetime, is that if it's a true rule breaker and I would say a generation-defining company of the sort that I hunt, buy, and hold, they start to do interesting things. Like Alphabet a few years ago starts to pay a dividend. And so all of a sudden, this thing that it was just about capital appreciation with no income, all of a sudden you start to get dividends. And that can be a wonderful reason later in our lives, if we've held something for a long period of time, to keep holding. And there are other factors as well. Of course, companies end up being bought out sometimes by others, so they appear to disappear, but they didn't actually go to zero. They just got eaten up by something else, and that thing itself spun off other things and morphed. And if you really follow the story, the long story of the greatest corporations, they go through many different dynamics. It's unpredictable.
So, one of the things that I thought about when I read your book was, should we expect the market going forward to resemble what we've seen in the past, right? Or could it be radically different, right? For example, we're seeing companies remain private for so much longer. I mean, SpaceX, and I want to come to that shortly. Is there the same kind of opportunity there was 20 years ago to find an Amazon or a Google, that went public much earlier than they do today? So is the public investor essentially the last chump on the train?
I think this is a great question, and it's one I ask myself, and it's one of those framing questions that you talk about and that you do in your own work, Vasant. And so I think it's a great framing question. Should we expect similar returns or similar dynamics from the next 50 years of the stock market that we've seen the previous 50? And I don't think there's any way I can answer that question. I don't think we can definitively say. I think we can say it base case, as you know, Philip Tetlock, as you know, super forecasting, sticking with the base case is a safer path, a more confident path than suggesting something radical. So my first answer is it's probably more of the same. And yet we all know that we are living through yet another incredible technological boom. We're right at the dawn of it for artificial intelligence. You and I were right there at the dawn of the internet. And there will be something more. Robotics will show up and it'll become the biggest industry of all time 10 years from now. And so could I say, sitting here in June 2026, the market will be the same in the future? No, I would never presume to do so. And yet, I think the stock market is the best place to be for our capital. And I have remained fully invested my entire life through every bad market, 2001, 2008, 9, COVID. I've been 100% invested all the way through on that roller coaster and every good market. And as you know, historically, the market returns around 10% annualized. And your question is basically, can we still expect that? And you do introduce something that disturbs me, which is the relatively recent phenomenon of companies waiting a long time to go public and then going public at gigantic valuations. And I guess the good news is that you and I don't have to buy the IPOs when they come out at $1 trillion. as you said earlier, what's the likelihood that would be a 5 or 10 bagger from here? Not nearly as good as when I recommended Amazon at a market capitalization of $1 billion. So certainly, in some ways, staying private longer has become more of a dynamic. And I also want to say there are so many great companies that aren't SpaceX, that aren't NVIDIA, that we can be invested in. And I have been and recommended them to Motley Fool members. Intuitive Surgical is a great example, that are much smaller, have been compounding for a while, and I expect will continue to compound with technological relevance and dominance within their own fields that make them the top dog and first mover in important industries. So while I'm a little sad that SpaceX is coming public at a $1 trillion plus valuation versus, let's say, $10 billion, it doesn't represent the entire market opportunity, at least as I think about it.
So two quick questions before we get into SpaceX, which I really do want to get into. One is, what other companies do you see now as opportunities that aren't already, multi-gazillion dollar companies?
Well, I would say it's a large number of them, and not every company that we have in our portfolio needs to be the next blank, the next Amazon, the next NVIDIA. So when I think about companies that I'm invested in today that I like very much over the next 20 years, I think of Netflix. I think Netflix is incredibly well positioned, and if all of our entertainment becomes AI generated and AI driven, I believe Netflix will have the resources to roll that direction just as well as anybody else. It's also a global brand in what was traditionally a local cable market, and of course, brilliantly led. So that's an example. That's my largest single holding personally, and so my money's where my mouth is. I mentioned Intuitive Surgical. For the man on the street, so-called, if you tap the random person at the bus stop and ask them if they know Intuitive Surgical, they probably don't. But the Da Vinci surgical robot for over 20 years has been increasingly the go-to robotic-assisted surgical machine that this company has manufactured, dreamed up, and deployed globally. And as more and more surgery goes minimally invasive, this company is beautifully positioned. It has an R&D budget larger than almost any competitor's revenue line. So that's another big favorite of mine. And both of those stocks I've held for more than 20 years. So I'm now describing where they are today, loving them in the next 20 years. But I also want to make it clear that I was right there at the start saying, this is my next recommendation. I think this will work. And by the way, Vasant, you know this about me if you've read my book. I'm willing to be wrong a lot. And I have made more bad stock picks than anybody in Motley Fool history. So while I love, of course, talking about what I think is going to win, and that's where I focus my time, one of the big themes of my life is we need to lose in order to be able to win. Rocket Lab is a great company. It's the little brother to SpaceX. It's been public for a few years now. It's been a multi-bagger for me as space is commercialized. This is a big story. It's not just SpaceX. And of course, as space gets commercialized, many new companies will emerge that we don't even know today that will become part of the ecosystem of outer space. So it's natural to start at things just to think Amazon's the only e-commerce company or Google's the only internet company. And then, as you know, 15 years later, all of a sudden Uber shows up or Airbnb, riffs off of what aren't just industries, but plate tectonic shifts in our culture. So I'm always curious about these things. And I also want to going back to earlier point in our conversation, I also feel I'm increasingly surrounded by people who don't care because they're just indexing because that's what they've been told. And so I feel like there's a huge amount of this is my phrase I use, big, dumb money sloshing around out there, which doesn't discern between Blockbuster Video and Netflix. It's just buying them both. And it's saying it wouldn't actually reward you to pick one over the other. I have spent my career and my life focused on excellence, believing that excellence will out. And even when I'm wrong and I pick Peloton, which ended up not being as excellent as I thought it might be, I've been wildly rewarded and beaten the market averages. So I also want to say that the more we hear people saying, it would just be luck, I will never bother investing because I could never pick a good stock, that actually makes it easier, the job that I do, I think. And so some thoughts.
Very well summarized, David. So the other quick question before I get into SpaceX, right, which also has to do with like when to sell. So you mentioned Salesforce as a great company. right? Do you think it's still a great company? And the reason there's a reason I asked this. I'll give you a little bit of background, right? Because as you know, some of my colleagues have built this Damodaran bot to simulate my colleague Aswat Damodaran, so a machine that sort of thinks like him. And about a month ago, maybe 6 weeks ago, I was at a conference on credit at NYU, and there was a lot of talk about software, and the meltdown in the whole sort of, and there was concern in the private credit space because there's a lot of private money, funding data centers, and a lot of their money is also in software. And I was speaking at that event later in the afternoon, so I just went up to my office and I fired up the Damodaran bot and I said, "What do you think about Salesforce, Adobe, and ServiceNow?" And it generated 3 reports for me, which I presented at the event. But I also ended up buying them, and this goes sort of against one of your rules of buying on a dip, right? Because these companies are selling at 50% or less than what they were selling a year ago, and the bot, was of the opinion that these are still great companies. There's a great deal of uncertainty that will get resolved over the next year, which will make it clearer as to whether their sort of seat-based revenue model, which is being replaced now by sort of a usage-based, like token usage-based model, is going to catch on. But it said that it seems to be kind of, that's kind of what ServiceNow is doing. And so I thought about those reports and I said, you know what, I think these are reasonable, but of course they haven't like gone through the roof. I'm sort of in the money, but I can't help but thinking whether you would actually be selling them now, after reading your book, because, you advise against selling too early, but would you be selling these software stocks at the moment?
Again, a lot of this is contextual, Vasant, right? So a lot of it would be, are these very, very large holdings? Are these holdings that I've been maintaining? Often, I think we tend to live in worlds of yes or no, on or off, black or white, buy or sell. I'm always trying to live in the gray world that is incremental. So I would probably, I had a friend who I respect the other day. I can't speak to the D-bot here, but my friend said, in so many words, Salesforce is toast. And that represents a viewpoint, which I know you're familiar with because you just spoke to it, that software as an industry is in deep trouble for reasons that would be self-evident to most listeners of this podcast. So I think what you did, Vasant, is you fired up the D-bot and whatever it said, you grew a conviction that these companies might be getting treated unfairly. That, in addition, like, yes, they're in software, but it's not like software is stuck in the 1990s. We've watched software growing up change its business model multiple times just to get to here. So assuming that they're just sitting asleep at the wheel, I think Mark Benioff is one of the genius entrepreneurs of our time. He's highly invested in Salesforce. Also, these companies tend to have a lot of cash and very little debt. And that gives you permission to be wrong for a while, evolve your model, etc. So I personally do not have strong conviction about whether it's a good or bad call to buy those companies right now. My default, if I already own them, is to hold. And I have been wildly rewarded because, and I hope this impression does not come across to the viewer or listener that I don't sell or I never sell. That is not the case. And yet, I believe that the vast majority of errors made by most people that I've observed, whether they're friends, neighbors, customers, etc., most people are selling too early and too often. So my advice, which is borne out by my numerical performance and my own lived experience, is you are surprisingly better rewarded for holding things than most people ever realize. And we're not just talking about stocks that might be down, like down 50%. Most people sell in the face of stocks going up. And of course, my book is full of examples, personally generated stock picks and things I've owned. I'm always just sharing it out, my own stuff there, of the companies that keep going up even more than you were thinking. And those are the shocking. That's why I have a 16-cent cost basis on Amazon and a 16-cent cost basis on NVIDIA, because I've maintained them in the face of people constantly saying, it's never going to keep going up. It can't keep going up, etc. So there's no way for me to give a simple answer to your good question, the right question about Salesforce. I do want to underline, though, that you care, that you study these things, you actually make investments. That is such a strength, because most people are doing it on paper or just in theory. You're actually in the arena yourself, picking stocks right in front of your students and thinking about these things. And I wish everybody were.
So let's talk about SpaceX. Everyone's talking about SpaceX these days.
We have to.
And Damodaran published a couple of pieces, one recently, as recently as last week. And I was really curious. So I had the Damodaran bot generate a report on SpaceX, which, I shared with you. It's sort of hot off the press. And, I don't know whether you have had a chance to look at it. But would you get into SpaceX at $135 a share and a 1.7 trillion valuation?
So this is a great question again. And my answer on the face of it would be, I'm comfortable doing so. I would not probably make it a large personal holding. I think part of what happens, the reason we feel a need to talk about SpaceX is because the IPOs that are massive raises of capital and huge valuations, there's a bandwagon effect that occurs throughout media. We're all part of it, where you have to talk about it. But humorously, or somewhat sadly, ironically, if you're actually trying to make an investment decision and you're just sort of getting into this subject is new to you, you think you have to have a position on SpaceX. You think maybe that would be the great one to buy because it's such a big IPO. And as you well know, when companies come public with massive valuations, they benefit hugely. So do the investment banks and those selling, the VCs who are selling to all of us. But we're actually not being sold a bill of goods. This is a fantastic company, but it's so large that it loses a lot of interest for someone like me. So when you say, David, would you buy this? I want my portfolio to reflect my best vision for our future. I believe that SpaceX is one of the more consequential companies of our lifetimes, and its sheer size and scale, and that we have to talk about it, proves that. And yet, it's not always the biggest thing that is the best performing stock. And so for me, I've already made many times my money off of Rocket Lab, ticker symbol RKLB, in the same industry, just a much smaller company than SpaceX. And Rocket Lab remains a much smaller company with the greater chance to multiply its value from here, I think, than SpaceX. And to give my final out the other side of my mouth answer, because I like to speak to all sides of things, Vasant, one of the consistent mistakes that people make over time is they think companies couldn't possibly grow to that big a valuation. The idea that there would be a $1 trillion company, or I have my hat since I was on the New York Stock Exchange committee at the time, Dow 10,000. I was right in your hometown there as the Dow hit 10,000. Seemed like such a big thing 30 years ago. The 1.7 trillion or whatever it is might sound like a big number. There will be $10 trillion companies. There will be $100 trillion companies in time. Don't think that it's too big to buy, or as it goes up further, that you missed it. So I've built a career off going against people's instincts, and there is an instinct out there that it would be hype, you should never buy it here, etc. And I don't agree with that. It's just that I'm not excited by it in the way that the media firestorm makes me think we all need to be.
Well said. I still wonder, coming back to SpaceX, which is a frontier company, when to buy. I wonder whether DBOT will turn out to be right in valuing it at half of its IPO value. How likely is it to get there is the $1 million question.
Well, it certainly is a possibility. And, when Facebook came public, I think it was back in 2012, maybe 2011, checking my math, but it was similarly considered a must-consider IPO, media talking about it. It was a pretty open process. It was, as I recall, it was sort of an open auction in a way that's more transparent than most IPOs. And as history will show, as it came public, raised a lot of money. Within, I think, a quarter, maybe 6 months, it had lost 30 to 40% of its value. And Many people, of course, said it's a failed IPO. Some people presumably left it for dead, but the rest is history. Of course, this has ended up being, it doesn't even have the same name anymore, a much larger company, a great buy if you were simply patient at IPO price to today. If you bought it on the dip, then you did even better in this particular case. And so, we can look for exemplars, pattern recognition, what computers are pretty good at. Humans can do it too. I try to do it all the time. What are some past examples? So I might liken this situation to that one. In answering your question, could it lose half its value? Yes. Yes, it could. And even if it did, does that mean it was a failed IPO? It shouldn't have come public. It was a mistake? Not necessarily. Maybe if we were to buy and hold over the next 20 years, which is more my kind of time frame, which most people in the media don't relate to, and many people with their own pocketbooks don't experience. That's why I've tried to show them the brave new world of actually holding for long periods of time the great companies of our era, which wildly beats the market averages. But we might look back and say it was actually a good buy at 1 trillion plus, because 20 years from now, it might be at 20 trillion. And so it might be a 10 bagger. Might.
Any ideas on Anthropic?
I'm impressed by Anthropic. I think it's funny that a company that, in my mind anyway, and Vasant, this is your area, not mine, but this is a company that with sort of a heart and with ethics proceeded at a scaled approach to solving the world's problems through AI. So, a little bit the good guys. And they sort of jumped ahead of OpenAI to file for their IPO. And now, of course, OpenAI is doing the same thing, confidential filing. I think these are both fascinating companies. They are both at or near $1 trillion valuations. Therefore, they're less interesting to me. In terms of expecting huge capital appreciation, I can find it elsewhere. And I admire these companies. I use their products. I love that they exist. I think they're good for the world, net. And if somebody wanted to base their portfolio here in 2026 on SpaceX, Anthropic, and OpenAI, I'd be like, those are solid companies. What 20 other stocks are we adding to this portfolio? Because to me, it's never about the one company.
All right. I'd love to know what those other 20 stocks.
Well, for all of us,
you've named a few of them.
That's really the whole point of my work is to help you think, but also have you think about what makes sense for you. So it's not always Amazon and Nvidia that end up being great companies. Chipotle has been a fantastic stock. It's had its ups and downs. Starbucks, which I open up at the start of my book with, has been a fantastic hold, which we've done for the last 30 years. So Palantir has been a great stock pick for me. This is obviously in the AI arena. Sort of, I would describe Palantir as one of the early practitioners or at scale deployers of artificial intelligence. So I lump it in the same industry. Axon Enterprise, I made brief reference to it earlier. Do you know what that company is, Vasant?
I do not.
Okay, that's fine. But that makes me happy because you are incredibly worldly, well-educated, and you love this stuff. And when I say a company and people don't know, that makes me feel a little bit better about it. Axon Enterprise
makes me feel like a fool, but
you know what? You're talking to one. So please be clear. I always wear that on my sleeve, and that's why we always encourage people to take themselves seriously. Us, not as much. But I would say that Axon Enterprise, you definitely know the company because the taser is how it started.
I see, yeah. Okay.
Obviously non-lethal weaponry, but then changed its name as they merged with the body camera company Axon. And these days, they have a third business model, the taser, the body camera, and then the cloud, where police departments across America, increasingly the world, are storing all of those videos from the body cameras. And this is a company that, like most of my rule breakers, conforms to the 6 traits that I'm looking for, is in a completely different industry that people don't really think about, and has been quietly a wild winner over the last 10 to 20 years, and I like it very much going forward. So those are examples of companies, and I'm not here to pound the table for any one of them. One of them might go out of business 3 years from now, and I'll be sad when it does. But my point is we should have diversified portfolios and not make it about SpaceX.
So David, last question before we wrap up. Why are you not a professional money manager?
So that's a great question, and we have them at our company. So I respect that. And but for me, my own orientation, since we started the Motley Fool from discussion boards online, my own orientation has always been toward helping, advising, teaching, answering questions. I love the interactive aspect of the internet. I love podcasts where I get to have conversations with amazing people. These are the ways I've wanted to spend my time. So what I ended up doing was saying, here's what I'll do. I'll jump in the batter's box back to baseball, and I'll take 3 swings at the market every single month, year after year after year, which is what I did. But you, dear reader, you, dear subscriber, dear fellow fool, you decide whether you want to buy that one or not. So a traditional kind of stock picking newsletter. Here's my next idea, buy it or not. And that's really how we buttered our bread at the Motley Fool. I like that business model even more than asset management because it's a subscription business model like Netflix. Netflix streams entertainment. We stream stock picks. They're a little bit bigger than we are. That's because more people are looking for entertainment than stock picks. But that's really the business that we built over time. We have added mutual funds. We have venture capital funds. These things exist under the Motley Fool umbrella. But Vasant, if you've gotten to know me some in this hour, and thank you for the privilege of the conversation, you'll know that I never felt called or interested in wanting to spend that much time focusing on the market minute to minute, day to day. I'm much more interested in being a thought leader and a voice leader and helping people to that promised land that does exist where you can be an owner of individual stocks, happy and market beating, and you don't have to be a Wall Street professional. That exists. It preceded me. It will come after me. But that's the halcyon field in which I throw my confetti.
Thanks for that, David. We do tend to act impulsively and often respond to data that are best ignored. I did an experiment. This was 15 years ago when we were trading proprietary capital at one of the big banks, where, some of my people felt like, we might be able to augment the algorithms with human judgment, right? So we did an experiment, right? We had a certain risk budget, that we allocated to each of us. And I never look at the markets. I just my view is, well, if I trust the algorithm, then it's doing its thing. I don't even look at this. And so we did a thing as to who would do better than the algorithm. We all did worse. And the first person to go down was the trader because she was always looking at the market, right? Could not resist acting and feeling like there was, something needed to be done. Whereas I never did anything. So I was the last man standing.
Well, there's a whole separate conversation that we're not having today, but it's about principle-based activity and rules-based activity. And there's a wonderful book called The Score by T. Nguyen, who is a philosopher operating out of the University of Utah. And if you've not come across that, or your listeners, I highly recommend A, reading it. Again, you may already know this, Vasant, and B, having him on this podcast because
I will do that.
He is a genius thinker about those two schools. And of course, AI is by definition algorithmic and rules driven. And humans are traditionally, we definitely have some rules driven aspect to us, but I'm a very principles, what are the things we're looking for based person. I'm also a purpose driven person as opposed to a goal driven person. So there are some different counterpoints running through our conversation that we didn't even get to, but I think a lot about those things. And he is a genius on this topic. Nguyen, T. Nguyen.
Okay, I will have him. But the last question, I said the last one was the last one, but this one really will be, which is, could the Motley Fool be replaced by the AI Fool, right? Because, you've laid out sort of your principles and rules. LLMs can do that. They can, they can understand sort of what you're talking about. So would the future Motley Fool be an AI Fool?
Well, my brother, who is our CEO, is endeavoring to replace the Motley Fool with the AI Fool. We have put lots of investments into artificial intelligence in our operations and our activity. And we actually have fewer employees than we did 3 years ago, not because we did layoffs, but because we did early buyouts, because my brother Tom believes that we don't need so many people doing the operations of the Motley Fool as we did 10 years ago or 20 years ago. So Vasant, I think this is very much our vision. I will also say that I think, and you can't ask me this question at the end. It's not fair because it's a whole conversation that we can't have. But I would just say that there's a place for both. And I believe that one of the things we do as humans is we can reframe things in ways that may not occur in dynamic systems like the stock market or the world at large and how it affects the stock market. We cannot reframe things. We can reframe things faster sometimes than AI, or it's always faster than we are. But does it even occur to AI to ask a different question? And I continue to believe there's a great book called A More Beautiful Question by Warren Berger, fellow New Yorker. You should have him on this podcast as well. And you know this already. It's about the prompts we ask. And the better educated you are, and the more visionary you are, the better the prompt, the more beautiful the question. And sometimes, while I know that AI ultimately could ask a question of itself and out-beautiful you and me, I believe, at least for the foreseeable future, that there will be value in our doing so. And I know you share that, having read your book, up to a certain point. Perhaps in the end, AI is just running everything. And if that's the case, I will be partying in the forest. Thank you.
By the way, is your brother's name Tom?
Yes.
Okay, so we'll see some tomfoolery when you realize your AI vision. Well, David, I really enjoyed this. Thanks so much. Been a pleasure talking to you. And this is to be continued the way I see it.
Thank you for suffering this fool gladly. And it has been a pleasure likewise. Thank you, Vasant.
Thanks.